Hello, I'm Jim Timmons, a Managing Director and Accredited Senior Appraiser from Teknos. Who is Teknos? We're a valuation firm, and that's important because we think that valuation is significant enough not to confuse it with accounting or investment banking or other functions such as some firms do. We focus on technology companies, and by that we mean life science and information technology companies. We think that they're among the most difficult to value. These companies frequently are experiencing rapid growth or are very complex in various ways, and they're undergoing an event which requires evaluation. So what sort of events require evaluation? Often a financing. That could be a private placement, or it could be in the run-up to an initial public offering. A sale of the company. It's obviously important to know what your company's worth in the course of negotiating with the buyer. An acquisition. In purchasing a company, there are accounting rules about how the assets of the purchased company must be placed on the acquiring company's balance sheet. A spin-out, or for that matter, a spin-in. It often is important to structure these in a tax-advantageous way, and it's important that shareholders get full value for the assets being spun out. A licensing deal. We know of some very significant licensing transactions where valuation played an integral part in getting the terms down. Compensation. In private companies particularly, the common stock must be valued on a regular basis to satisfy tax and accounting rules, or the executives and board members who receive stock options can be subject to some very substantial penalties. And finally, in litigation, knowing the extent of damages or defending against litigation as well. Teknos has a very broad life science background. We've worked with literally many dozens of companies in the pharmaceutical, biotechnology, medical device, and information technology pertaining to life sciences categories. And you can see on this screen the logos of some of the companies with which we've worked in the past. I've got a few case studies which I'll run through very quickly that demonstrate some of our skills. For instance, we have provided fairness opinions on the sale of a company. One instance which we confronted was a venture capital company being sold to a corporate partner with which it had worked closely in the past. There was concern about the ability to negotiate price with that development and marketing partner and essentially not drive away that marketing partner in the process. And there was also a concern about how the value would be allocated to the preferred and common stock, which made up the capitalization of that private company. We were hired on a very short basis, a little before Christmas of one year, with an announcement of the deal planned for early in the new year. Not much time. We prepared multiple valuation analyses. We compared the value in a variety of different scenarios. We presented to the board of directors. We provided a fairness opinion that later was placed in the shareholder proxy statement, mailed out to all the shareholders. And as a result, the board was very comfortable with the value and felt that it could be more firm in its negotiations with the larger company that was moving to acquire it. And we quelled the potential for unhappiness and discontent among the common shareholders because the preferred shareholders were getting most of the value in that transaction. In another case, I've mentioned already that we sometimes work on spin-outs. We had a venture-backed company that was working on two different life science product lines, and it had put itself on the market. There had been a variety of potential corporate buyers that had shown some interest, but no one was interested in both product lines. Companies only wanted one product line. The very tricky task was to figure out how to value the entire company and the two product lines and essentially split the company in two. We helped structure a split of the preferred stock and the stock options. You can imagine that there have been people who'd worked for many years and they wanted to receive value from both companies, from the events that would take place at both companies. Ditto the venture capitalists. They wanted to make sure that they got a proper return on their investment in each of the two companies. And it was also a goal to try and structure the transaction as a tax-free spin-off to the shareholders. So there were a lot of conflicting valuation issues. The result was we provided valuations that allowed them to legally separate the two companies, to cross-license the necessary technology to each other, in a very short order, one company was purchased a few months later, the other was purchased less than a year later. Total value to the shareholders nearly 2 times the original value. Everyone was very happy with that transaction. I mentioned already that the issue of granting stock options is very sensitive at private companies. There have been a variety of new tax and financial accounting regulatory requirements about this. We have been very frequently brought in to provide valuations for these companies, to use a Black-Scholes model to allocate value. We deliver these valuation reports to the board of directors. We've answered review questions from Big Four and other audit firms, and in a few cases where the companies have gone on to go public, from the SEC. And the result is, in all these cases, the companies are able to issue stock options without concerns about tax liability to the employees. And incidentally, the federal tax rule, IRC 49A, imposes a 20% surtax. California matches that with another 20% surtax, bringing total taxation, if something's done wrong here, to about 90%. So it's a very sensitive area. At the end of the day, companies are able to deliver audited financials and complete IPOs without problems and without tax liability to employees. Another case study concerned a public company acquiring a smaller private company. It was a very complex deal, and about 50% of the total transaction value was to be in an earnout, and it was essentially a two-step earnout. The first step to be FDA approval of the compound on which the smaller private company was working, and the second to be then meeting sales targets for that compound once it had FDA approval. The task was very difficult because the public company had to report the financial effect of this earnout at the time of the announcement of the deal. So here's a public company having to figure out what's going to go on years from now with an FDA approval process, with meeting sales targets, and put that in terms that show the immediate impact on the balance sheet and the income statement for the benefit of shareholders today. We got involved before the deal was announced. We were in with the accountants, the lawyers, the investment bankers, modeling a variety of different earnout scenarios and preparing the company for its announcement and its filing of an 8K with the SEC. We prepared a purchase price allocation report under the relevant accounting standard, which is ASC 805, for the company's 10K filing with the SEC. Then quarterly thereafter, we re-examined the earnout assumptions and helped the company with what's called impairment testing under ASC 350. And at every step, we answered review questions by the Big Four audit firm, which covered that larger public company. So as a result, our public client was able to very rapidly disclose the income statement and balance sheet effects of the deal to investors and to the SEC, keeping everybody fully informed and happy. And final case study concerns litigation against a corporate partner. We had a biotech development company developing a very promising compound. It signed a deal with a large pharmaceutical company for marketing and manufacturing support. The biotech company completed its phase 3 trials and, not surprisingly, was given fast-track status by the FDA. Meanwhile, the large pharmaceutical company missed manufacturing milestones, whether unintentionally or intentionally, we still don't know. And the biotech company lost several years of very valuable patent life. It has already been about 10 years, and you can imagine, given how short patents are, that that was very frustrating and economically damaging. We prepared a so-called with and without analysis to show the value that was lost because of the lost opportunity. And we testified in a grueling deposition and in a trial that went partway through. The biotech company ultimately received a large settlement from the large pharmaceutical company before the verdict was delivered because the large pharma company saw the direction in which things were going, and again, a happy outcome. So, to sum it up, how can Teknos help your life sciences company? Well, we offer high-quality valuation reports that meet the high standards of both the financial accounting, the GAAP, and the tax rules. We have a skilled staff in Silicon Valley that's trained by the American Society of Appraisers and by the CFA Institute. We provide very rapid delivery of our reports, and there's easy interaction with the audit firms who ultimately review the reports and decide whether they can be accepted in the preparation of your financials. We have a lengthy experience. We've completed more than 750 of these reports in recent years, and also fairness opinions. Our work's been reviewed by all the major audit firms and by the SEC and never found wanting. And last but not least, we're very thrifty in our use of scarce resources at young companies, and those are chiefly management time and fees. So I think all in all, you would find that we would provide a very good experience, and we would do so on a basis that would be beneficial to you. Thanks for listening, and I hope to meet you at the conference. This is Jim Timmons, Managing Director and Accredited Senior Appraiser at Teknos. Thanks.